If you run a limited liability company in Nigeria, you must understand your tax duties. This is not just about following the law, it is about protecting your business's financial health and future. Ignoring taxes can lead to heavy penalties and interest charges. These costs can drain your company's resources. They can stop your growth before it even begins. Good tax management is a fundamental part of good business management. Knowing your obligations allows you to plan your finances with accuracy. It helps you avoid surprises that could disrupt your operations and damage your reputation with regulators. It helps you avoid surprises that could disrupt your operations and damage your reputation with banks. It helps you avoid surprises that could disrupt your operations and damage your reputation with partners. Your ability to navigate the tax landscape is directly linked to your company's long-term survival and success. Compliance is more than just paying what you owe. It is about building a foundation of trust and legality for your enterprise. This can make it easier to get loans from banks. It can also help you attract serious investors. It can also help you win contracts with large corporations. It can also help you win contracts with government agencies. They often check a potential partner's tax compliance status before doing business. Staying on the right side of the tax authorities prevents legal trouble. It saves you from the stress and expense of audits and investigations. Think of tax compliance not as a burden, but as a strategic advantage that strengthens your business from the inside out. The Nigerian tax system is undergoing significant changes. The government is working hard to increase its revenue. It is also trying to make the system more efficient. This means that enforcement is becoming stricter and more sophisticated. The days of flying under the radar are over. Tax authorities now have powerful digital tools to track business activities. Every payment you receive can leave a digital footprint. Company's income tax, or CIT, is a tax on the profits your company makes. If your business is profitable, you will likely need to pay CIT. The standard rate is 30% for medium and large companies. However, the law provides important relief for smaller businesses. The Nigeria Tax Act 2025 has updated these rules. A small company is now generally defined as having a turnover of 100 million naira or less. If your company meets this definition, you are exempt from CIT. This is a huge benefit designed to help small businesses grow. It means you can reinvest all your profits back into the company without paying income tax. A new tax called the development levy was introduced effective the 1st of January, 2026. The new development levy is 4% of assessable profits. It applies to companies that are otherwise chargeable to tax, except for exempt categories such as small companies and non-resident companies in the relevant context. For medium-sized and large companies, this means that tax planning must go beyond the standard corporate income tax rate. A company may be required to account for both companies' income tax and development levy, which increases the overall effective tax burden. If your company sells taxable goods or provides services that are subject to VAT, you must act as a collection agent for the government. You must add 7.5% to your invoices and collect this amount from your customers. This money does not belong to your company. You are holding it on behalf of the Federal Inland Revenue Service, After collecting VAT, you must remit it to the FIRS through a monthly filing process. Your VAT return and payment are due on or before the 21st day of the following month. For example, VAT collected in March must be filed and paid by April 21st. The list of VAT-exempt items has expanded. Withholding tax, or WHT, is another important aspect of company taxation in Nigeria, although it often operates as an advance tax or tax credit rather than a separate final tax. When your company pays for certain services or receives certain types of income, WHT rules apply. If you are making a payment to a supplier, professional fees, rent, construction contract, you may be required to deduct WHT. The rate varies depending on the nature of the transaction. Once deducted, the company must remit it to the tax authority. WHT responsibility is serious. If you fail to deduct when required, you can be held liable, with penalties and interest. For this reason, companies should review contracts, payment processes, and vendor classifications carefully before making payments. The Nigerian tax landscape is changing dramatically with the Nigeria Tax Act 2025. This new law became effective on January 1, 2026. It marks a major overhaul to simplify compliance, broaden the base, and increase revenue. Companies must urgently review operations and tax strategies. The first and most important step is to maintain meticulous records. Good bookkeeping is the backbone of tax compliance. Keep detailed, accurate records of all income and expenses. Save every invoice, every receipt, and every bank statement. Use accounting software. Hire a bookkeeper if needed. Review financial statements monthly. This helps you file correctly and see business health clearly. Without clean records, you cannot manage CIT, VAT, or defend expenses in an audit. Register for VAT if required. Issue proper tax invoices. File by the 21st, even for nil returns. Register employees, deduct correctly, remit pay. Review supplier payments, know when to withhold, remit WHT on time. Finally, seek professional help. Tax rules change often. Investing in expert advice protects you from penalties and builds a sustainable business in Nigeria. Thank you for watching.